world has withstood multiple shocks, and I call it triple shocks of COVID-19 pandemic, then the war in Ukraine, and now the financial market turmoil. The financial market turmoil is mainly emanating from the synchronized monetary policy tightening across the world by central banks, especially the advanced country central banks, led by the US Fed. And naturally, the spillovers are felt by the emerging market economies, like including India. So, in this kind of successive, turmoil that the world has gone through, that has left the entire European Union is today facing a recession situation. They're on the brink of a recession, but there are possibilities that they will avoid that. United States is holding stable, but there are other countries also where the growth has slowed down. Now, so far as India is concerned, economy, overall macroeconomic fundamentals, the financial sector stability, all these aspects, they remain resilient. The banking sector, that is the financial sector, is stable because all the parameters with regard to banking or the non-banking lenders or the other major financial sector players, you look at the data, I don't want to, load too much of data on you. They are stable. Overall, the financial sector in India is stable. The growth numbers are looking good in the current context. Our estimate is that India will this year grow by about 7%. The IMF has projected that India will grow by about 6.8% in the current year. And that puts India among the fastest growing major economies in the world. We have a major challenge with regard to inflation, but comparatively, if you see, our target, the upper ceiling is about 6%. The last inflation number which was released for September, the inflation was 7.4%. We expect the October number which will be released on Monday, we expect that to be lower than 7%. So therefore, inflation is a matter of concern with which we are now dealing effectively. For the last 6 months or 7 months, we have taken a number of steps. We have increased the interest rates, and government also has undertaken several supply-side measures. So overall, just to sum up, the macroeconomic fundamentals of India remain strong and resilient. Growth prospects are looking good. As we assume the G20 presidency in 2023, I think India is taking over the presidency of G23 at a time in a year which is perhaps the most challenging year in modern times. And we are assuming presidency of G20 with stronger macroeconomic fundamentals compared to many other countries.
Inflation, you spoke about inflation, and in keeping with your mandate, one part of your mandate as central bank is inflation management. You sent a letter to the government explaining the whole process of management of inflation and why it is still above the band. Can you tell us what you said in that letter, or is that information confidential?
No, what we have written in the letter, I think anybody can make an intelligent guess. Basically, the law requires that when for 3 consecutive quarters the inflation remains above 6%, it will be treated as a failure of monetary policy, and the Reserve Bank is required to write a letter to the government highlighting 3 things. Number 1, what are the reasons for which it has happened? What are the principal reasons behind that? Number 2, what steps the Reserve Bank proposes to undertake to bring it down below 6% and closer to 4%, which is the target rate. And number 3, what is the time frame within which we expect inflation to come back to the target level? So we have broadly explained the reasons as to why it happened, and I have spoken about it on several occasions. In fact, I think about a week ago, I also spoke in one conference in Mumbai, where I have explained why the inflation went up in India. Now, in February this year, when we met in the Monetary Policy Committee, our inflation projection, and which was not different from what the market, the professional forecasters were estimating, we projected in February this year that our average inflation in 22-23 financial year will be about 4.5%. We did stress tests assuming crude oil even at $100. And we found that even at $100 per barrel of crude oil, the inflation would be maximum 5%. That was the estimate we had made in February. Then on 24th February, the war started, and naturally it completely changed the picture. And thereafter, the crude oil hit $130 per barrel before coming down to 120. It remained around 120, 110 for considerable period of time. Now, of course, it has come below 100, but it ranges between 93, 95, 96. So in February, it looked that the inflation is well under control and India is well on course to reach the target of 4%. But the geopolitical crisis, the sudden spike in commodity prices, the sudden spike in edible oil prices, the sudden spike in prices of cereals, wheat, for example. We have surplus wheat, but price of wheat in India also went up because we are a part of the globalized world, and the international prices of wheat went up because, from the Black Sea region, a lot of wheat exports goes into the rest of the world. So we were impacted by major external factors, and the entire inflation picture underwent a particular change.
If oil stays where it is, or it continues to range round about what you're saying it will range at, which seems like a conservative estimate, right? I mean, $95, it could go up. The problem is we don't know what is going to happen with the war. It seems to be a war without end. And global inflation isn't easing. There's already some talk that maybe we need to revise our inflation band, that we've got a certain inflation band, maybe India's inflation target needs to be revised upwards. What is your thinking on this?
You see, there is a reason why the target has been kept at 4%. There was a committee in the Reserve Bank which it was an internal committee of the Reserve Bank, which did a detailed analysis and found that 4% inflation target with a price band of plus minus 2%, so that we have a range of 2 to 6%. And the RBI research at that point of time found, and even now that holds good, that inflation above 6% for India would be detrimental to growth. It will be counterproductive because it will act, it will act through a negative loop. You will have, if it is above 6%, the financial savings will be hit, the investment climate will hit, India will lose the confidence of international investors if it remains above 6% for a prolonged period. So any inflation above 6% is detrimental to growth. So therefore, 6% has been kept as the upper tolerance band. And the fact that we have a tolerance band, between 4 and 6%, that gives RBI enough policy space to use during times of stress, as we did during the COVID-19 pandemic. Although the inflation was about 5.5%, the Monetary Policy Committee very consciously and quite rightly decided to tolerate higher inflation, because during COVID, the priority was to support the economy by keeping liquidity easy, by keeping the interest rates lower. During COVID, we could not, when the COVID had still not ended, when the economy was still facing a lot of stress, and that year we had a negative growth, a negative growth in India after a long, long time. So therefore, that was not the time to start your monetary policy tightening. So this range we have between 4 to 6% gave us the flexibility to keep the monetary policy supportive of the economy, and we decided to deal with the inflation at a later date, that is after, after things are under control. So this year in April, when we started the change in our stance, last year's growth, 21-22 growth, I think that last year's growth was, what was the growth last year? It was about, I think, 7.7%. It was 7.7%. And so that was the time we changed course. So coming back to your principal question, is it the time to change the interest rate, the whole regime? I would say that 6% target, that is 2 to 6% with 4% as the main target, makes a lot of economic sense. And we should not think of shifting the goalpost because, because we have not been able to meet it. We remain committed to bring it down, bring the inflation down to 4% over a period of time.
Question that follows is simply whether the shocks that you spoke of, the externalities, are they unprecedented enough for us to think in terms of making a change, or do you think these are shocks that you've negotiated before as a country and can negotiate again?
No, it's too early. In fact, I would not like this debate to start prematurely. I think it's too premature to enter into that debate. It will only mean less commitment of central banks to fight the war against inflation.